So, think about when you bought your tea or coffee this morning.
Yeah, or even just paying for a cab.
Right. Did you actually hand over physical paper bills? Probably not.
Most people don't these days.
Exactly. You likely tapped a card or, scanned a QR code on your phone.
And the transaction felt completely instant. The vendor got a notification and you just walked out.
Right. So the reality is, for most of us, our money is already digital.
It is. But that brings up a really interesting question.
It does. Because if our money is already digital, why are central banks and massive tech giants suddenly spending billions of dollars racing to build these new things called stablecoins and CBDCs?
It is a massive shift, actually.
It really is. So, welcome back to our deep dive. As part of our Crypto Beyond the Hype series, we are looking at the actual plumbing of global finance today.
Right. Because the money you use today might feel digital to you, but at the back end, it is still running on very old legacy infrastructure.
What we are seeing is a move from a world where money is just a digital message sent between old databases to a world where money is basically a programmable asset on a network.
Exactly. And that shift is splitting into two very distinct paths.
The private market route and the government route.
Right. So let's jump straight into the mechanics of this, starting with stablecoins.
Yeah, let's break that down because we all know the basic definition, right? They are crypto tokens pegged to a stable asset.
Usually the US dollar.
Right, usually the dollar. But the interesting part is actually how they maintain that peg.
See, a lot of people assume stablecoins are just, digital dollars, but they are actually more like a private IOU.
An IOU from a tech company.
Basically, yes. For a fiat collateralized stablecoin to work, the private company issuing the token has to hold an actual dollar.
Or like a U.S. Treasury bill.
Exactly. They have to hold it in a traditional bank vault for every single token they issue on the blockchain.
Which introduces a very specific vulnerability, if you think about it.
It absolutely does, because your trust in that stablecoin is entirely dependent on the issuer's balance sheet.
And their third-party audits, right?
Yes. If the market suddenly doubts that those reserves are actually sitting there, you get what we call a depegging event.
Right, where everyone panics.
Exactly. People rush to redeem their tokens for real dollars, the private reserves dry up, and the stablecoin essentially collapses.
We have actually seen this happen before, right? With algorithmic stablecoins.
Oh, yes. Those were quite different. They tried to maintain their peg using complex code and incentives instead of actual cash reserves.
Right. And when the code failed to account for extreme human panic, the value just went to zero overnight.
It was a disaster for a lot of people.
So using a stablecoin feels a bit like using digital casino chips.
That is actually a perfect analogy.
Right, because you use them at the tables because they're easy to handle. But your trust relies entirely on the belief that the privately owned casino will give you real dollars back when you decide to cash out.
Exactly. You are trusting a private company to act as a shadow bank.
Which brings us to the other side of the coin. Let's contrast that with a CBDC.
Right, a central bank digital currency.
Now, on the surface, people listening might think, well, I already have digital dollars in my banking app. How is a CBDC any different?
And that is the most common point of confusion, but the underlying mechanism is fundamentally different.
See, when you look at your checking account balance today, that money is commercial bank money.
Right. It is a liability of your specific private bank.
If your bank goes under, your money is at risk, barring any government deposit insurance.
But a CBDC is a direct liability of the state. It is central bank money.
So when you hold a CBDC in a digital wallet, you basically have a direct account with your country's central bank.
Exactly. There is no commercial bank sitting in the middle managing that ledger.
It is the exact digital equivalent of holding a physical government-issued banknote in your hand.
Right. The credit risk essentially drops to zero because the institution issuing the money is the exact same one that prints it.
The source of trust is completely different.
That is the biggest takeaway here. With stablecoins, you trust a tech CEO. With CBDCs, you trust your country's monetary system.
Which naturally brings us to the obvious question. If the current commercial banking system worked totally fine for most of our daily purchases, why are we trying to bypass it?
Why are incredibly smart people spending billions to build these new systems, right?
Exactly. I was looking at the bigger picture regarding correspondent banking, and it is fascinating how broken cross-border payments actually are.
Oh, they are incredibly inefficient.
Right. We expect emails to travel across the globe instantly for free. But if I want to send money to a supplier in another country, My bank doesn't just beam the money over.
No, they use a messaging system called SWIFT.
Right. My bank sends a message to an intermediary bank, which adjusts a ledger, and then sends another message to a final bank across the globe.
Which then adjusts another ledger. It is literally a game of financial telephone.
And at every single hop in that chain, liquidity gets trapped.
Exactly. The banks have to maintain what are called nostro and vostro accounts.
Basically, pre-funded accounts sitting in foreign countries just waiting to facilitate these transfers.
Right. It ties up trillions of dollars in dormant capital globally.
And it takes, what, 3 to 5 business days to clear?
Yes. And it incurs fees at every single step. It is a massive friction point.
Because the internet eliminated borders for data, people got incredibly frustrated that money couldn't move the same way.
And crypto traders were the very first people to hit this wall.
Because crypto markets operate 24 hours a day, 7 days a week, globally.
Exactly. But the traditional banking system closes on weekends and holidays.
Right. So traders needed a way to move a stable asset across borders at 2 a.m. on a Sunday.
Without waiting for a bank in New York or London to open on Monday morning.
So they built stablecoins to solve that exact friction problem.
Right. A stablecoin doesn't rely on correspondent banks adjusting ledgers. It is a bearer asset on a blockchain.
So when I send you a stablecoin, the actual value settles in your wallet in seconds.
Final and irrevocable, regardless of the time zone. It is a private market solution to a digital bottleneck.
And once stablecoins started moving billions of dollars a day, government suddenly woke up.
They absolutely did. They looked at this massive flow of value happening completely outside the traditional banking perimeter.
And they realized that private tech companies were starting to wield the kind of monetary influence that usually belongs to sovereign nations.
Right. It forced central banks to ask themselves a very difficult question.
If the future of money is moving onto blockchain networks, do we just hand over that territory to private tech companies?
Or do we build our own public infrastructure? Because if people start using private stablecoins for everyday commerce, central banks lose their ability to manage the economy.
Right. They lose visibility on how fast money is moving.
And their interest rate adjustments stop having an effect on the broader market.
So that loss of monetary sovereignty is really the primary driver behind the massive push for CBDCs.
Basically, yes. So we have these two radically different approaches trying to solve the exact same problem of moving money efficiently.
It actually reminds me of infrastructure development. See, stablecoins operate almost like a network of high-speed private toll roads.
That is a good way to put it. Tech startups can build them incredibly fast.
Right. If users want a new feature, developers just write the code and deploy it the next day.
But because they are private, they are optimized for profit.
And specific use cases. And the safety standards are entirely dependent on that private company actually maintaining the road.
Meanwhile, a CBDC is like upgrading the entire national highway system.
You can't just move fast and break things.
Exactly, because if you introduce a bug into a nation's official currency, you could literally collapse the economy.
The burden of public money is just incredibly heavy. Building a CBDC requires integrating with existing legal frameworks.
And ensuring military-grade cybersecurity. And guaranteeing offline capabilities.
Right, that is a huge point. What happens if a hurricane takes out the power grid for a week?
Physical cash still works fine in that scenario.
So a digital sovereign currency must have a mechanism to settle offline transactions, maybe via Bluetooth.
Or near-field communication, which, as you can imagine, is incredibly difficult to engineer securely.
It is slow by design because it reflects a society's core infrastructure.
Exactly. And I'm really glad you brought up the engineering side, because this is where the conversation usually shifts from mere convenience to some very intense debates about control.
Right. Let's talk about programmability. This is fascinating.
It is. See, with traditional digital money, a dollar is just a dollar.
But both stablecoins and CBDCs can utilize smart contracts,
Right. You can actually write code directly into the money itself.
dictating exactly how, when, and where it can be spent.
Programmable money completely changes the paradigm. Think about government subsidies or disaster relief.
Right. Historically, distributing aid is slow and unfortunately prone to massive fraud.
People receive checks, and sometimes the funds are intercepted or spent on entirely unrelated things.
But with a programmable CBDC, a government could instantly airdrop funds directly to the digital wallets of citizens in a specific disaster zone.
And they could code those digital dollars so they can only be spent at verified grocery stores.
Or hardware stores. And
Yeah.
maybe even set an expiration date, right?
Exactly. So the funds simply disappear if they are not injected into the local economy within, say, 30 days.
On paper, the efficiency and targeted impact of that is just incredible.
It is a policymaker's absolute dream. But the flip side of that exact same technology is what causes so much public resistance globally.
Right, because if a state institution has the power to program money for good, they inherently have the power to program it for restriction.
Yes. And this is why CBDC conversations are so highly debated.
I see where you're going. This sounds like a pick-your-poison scenario for ordinary people.
It does feel that way sometimes.
A lot of critics point out that if your digital wallet is tied to a digital identity, programmability could be used for social engineering.
Right. The system could automatically restrict your wallet from purchasing airline tickets if you have exceeded a certain carbon footprint.
Or freeze your funds instantly if you participate in an unsanctioned political protest.
With cash, transactions are anonymous and peer-to-peer.
But with a retail CBDC, the government could theoretically have a real-time, granular view of every single purchase you make. We either give the government a direct view into our wallets, or we hand over our transaction history to a private tech CEO.
Neither sounds entirely comfortable, right? Which is why the architecture of a CBDC is so fiercely debated right now.
So how are countries handling this?
Well, do you build a system that prioritizes privacy, using cryptographic zero-knowledge proofs where even the central bank cannot see the transaction details?
Or do you prioritize transparency to combat money laundering and tax evasion?
Exactly. Different countries are choosing very different architectures based on their own political values.
And with stablecoins, you have similar privacy concerns, right?
Yes, but the data is being harvested by private corporations for commercial profiling rather than by a state for surveillance.
It is a massive trade-off.
Yeah.
But there is another structural risk here that really doesn't get talked about enough.
What is that?
What actually happens to our traditional commercial banks?
Ah, yes. The banking impact.
Right. I mean, if I can hold my money directly in a stablecoin wallet or directly at the central bank via a CBDC, why would I ever leave my money in a standard checking account?
Especially one that pays new zero interest. You have hit on the exact reason why central banks are moving so cautiously right now.
Because commercial banks are basically the engine of credit in our economy, right?
Exactly. They take our deposits and lend them out to small businesses or use them to fund mortgages.
So if a new digital currency is introduced and it is simply too attractive, you get massive disintermediation.
Consumers will pull their deposits out of commercial banks and move them straight to these new platforms.
It fundamentally changes the mechanics of a bank run.
It really does. Let's look at recent banking panics. Historically, if people get spooked, what happens?
They line up around the block to withdraw physical cash,
Right. It takes time, and bank branches physically run out of paper money.
which ironically actually buys regulators time to step in and calm the market down.
But imagine a scenario where every citizen has a retail CBDC app on their phone.
Oh, wow. The friction of the bank run just drops to zero.
Exactly. At the very first rumor of instability, millions of depositors could simultaneously just swipe right on their phones.
Transferring their funds from commercial bank liabilities directly into ultra-safe central bank money.
Trillions of dollars in liquidity could drain from the commercial banking sector in a matter of seconds.
A completely silent, instant bank run,
And if commercial banks lose their deposit base, they lose their ability to issue loans.
which completely seizes up the entire credit market.
Right. So to prevent this, many central banks are leaning toward what is called a wholesale CBDC model rather than a retail one.
Okay, let's clarify that for everyone. A wholesale CBDC isn't for ordinary people, right?
Exactly. It is only for commercial banks and large financial institutions to settle transactions with each other instantly.
Ah, so it fixes the cross-border friction and that Nostro Vostro account problem we discussed earlier.
Yes, but without disrupting the retail banking sector.
So the commercial banks would still handle the customer-facing apps that you and I use.
But the settlement layer between the banks would run on the central bank's new blockchain.
That actually makes a lot of sense. It is like upgrading the plumbing without tearing out the sinks in our houses.
That is exactly what it is. But looking at the global landscape, it seems clear that there is no one-size-fits-all approach.
Right. How people react to these trade-offs largely depends on where in the world they are sitting.
Yes. The ground reality dictates the technology. Take emerging markets, for example.
Where there might be an unstable local currency.
Exactly. If you are living in a country facing hyperinflation, where the local currency loses purchasing power weekly, You don't have time to wait.
Waiting for a government to cautiously build a wholesale CBDC does not help you buy groceries today.
No, it doesn't. In those environments, fiat collateralized stablecoins are not some speculative crypto experiment.
They are a vital lifeline for practical survival.
We see massive adoption in countries where citizens use stablecoins on their mobile phones to instantly swap their depreciating local wages into digital US dollars.
It gives them access to a stable global reserve currency without even needing a foreign bank account.
For them, the sheer speed of private tech is solving a daily urgent crisis.
But then if you shift focus to a developed nation with a relatively strong central bank, say the Eurozone or the UK, the calculus changes entirely.
Right. Citizens there aren't fleeing to the dollar to escape hyperinflation.
The authorities there are looking at CBDCs defensively. They want to modernize their infrastructure.
They want to ensure that as society goes cashless, the core unit of account remains sovereign money.
Not some token issued by a Silicon Valley tech conglomerate.
Exactly. They want to preserve the public nature of money.
So is this a winner-takes-all battle between private stablecoins and public CBDCs?
Not at all. When you look at how these two forces are colliding, we are clearly moving toward an ecosystem of coexistence.
An ecosystem where the tool you use depends entirely on the context of the transaction.
Right. We will likely still have physical cash for local private transactions.
And we will still have traditional bank apps for direct deposits and long-term mortgages.
But we will use stablecoins to instantly settle global online commerce, bypassing the old SWIFT network.
And we might have wholesale CBDCs running quietly in the background, allowing commercial banks to settle those transactions securely.
Or perhaps retail CBDCs used specifically to disperse government benefits or collect taxes efficiently.
So the architecture of money is simply fracturing into specialized layers.
Yeah, it is exactly what we are seeing.
Let's summarize the key takeaways from our deep dive today for everyone listening.
Sure.
Stablecoins and CBDCs are both attempting to upgrade the legacy plumbing of global finance by turning money into programmable data on a network.
But they operate on entirely divergent foundations of trust.
Right. Stablecoins offer the sheer speed and borderless nature of private tech, backed by corporate reserves.
But they carry the risk of depegging and, of course, private data harvesting.
And CBDCs represent the slow, cautious modernization of sovereign state money.
They eliminate credit risk because they're backed by the state, and they offer incredible tools for policy efficiency.
But they introduce profound questions regarding surveillance, programmable restrictions, and the potential destabilization of our commercial banking sector.
Exactly. As this technology rolls out over the next few years, you really don't need to be a blockchain engineer to navigate it.
Just don't get swept away by the fear or the hype. Look past the marketing jargon and ask human questions.
Right. Ask yourself, who actually controls the ledger? What specific asset is backing the value?
And who has visibility into the transaction data?
Once you understand the mechanics beneath the surface, the hype fades away.
And you can see these tools for what they really are.
Yeah.
Just the next evolutionary step in the long history of human ledger keeping.
Very true.
Well, thank you for joining us on this deep dive. We hope this conversation has given you a clearer framework for understanding the future of your wallet.
It is a massive topic, but staying grounded in the basics really helps.
Absolutely. Make sure to follow the Crypto Beyond the Hype series, and if you found this breakdown useful, share it with a friend.
Share it with someone who is still trying to figure out why their digital money needs an upgrade.
And drop a comment on what question you want answered next. But before we wrap up entirely, I know you had one final thought.
Yes. I want to leave you with a final scenario to just mull over.
Okay, let's hear it.
We talked about how efficient a digital, programmable monetary system could be.
Right.
If we truly arrive at a future where we use a private stablecoin network to instantly buy a car from overseas, and we use a state-issued CBDC wallet to securely pay our property taxes from our phone. What exactly is the purpose of that massive, traditional brick-and-mortar bank branch sitting on your neighborhood corner?
Oh, wow.
In a few years, will those grand old banking buildings just become museums, monuments to how money used to move?
A museum of legacy money.
Yeah.
That is definitely something to think about the next time you walk past a bank branch.
It really is.
Thanks for listening, everyone. Keep staying curious, and we will catch you on the next deep dive.